Buybacks, buybacks and buybacks. It is the season of buybacks. A slew of large and small companies have announced share buybacks recently. Piramal Enterprises announced its first share buyback after 12 years, while Larsen & Toubro, the infrastructure giant, also announced its first ever share buyback. But are share buybacks attractive for investors? What are the kinds of share buybacks? Which ones are more lucrative for normal retail shareholders like you and me? We'll tell you all of that in this video. First up, let us tell you what actually a share buyback is. A share buyback is when a company repurchases its own shares from existing shareholders to reduce the number of shares in the open market. But why would a company do a buyback instead of issuing fresh shares? Well, they can do fresh shares too, but they have multiple reasons to do a buyback. One, a buyback helps the company increase the shareholding of its promoter. Two, it helps support the share price and pay surplus cash to its shareholders. 3. As the number of outstanding shares in the open market reduce, the company's earnings per share automatically goes up. And lastly, to safeguard the company against any potential hostile takeover. Generally, share buybacks are of two kinds. One is through a tender offer and the other is through the open market. We'll explain both of these to you going forward. Let's now tell you what a tender offer buyback means. A tender offer buyback is when a company announces a buyback of its shares at a fixed price. Now, buybacks announced by L&T, Piramal Enterprises, Aarti Drugs are all tender offer buybacks. Wipro recently completed its buyback at 445 rupees a share. L&T has a maximum buyback limit of 3000 rupees per share. Now, that means that the shareholders cannot tender their shares at a price higher than 3000 rupees. Now, tender offer buybacks are generally announced at a premium to the current market price, thereby making it attractive for the shareholders. Both Piramal and L&T share buybacks were at a premium of 16% each to their then market price, while that of Aarti Drugs was at a premium of nearly 50%. A tender offer buyback also remains open for a limited period of time. But is it mandatory for you to tender your shares in a buyback? No, that's up to you. If you are confident about the company's prospects, you can even choose to not participate in the buyback. But a common market logic, especially for a retail shareholder, is that you tender your shares in the buyback and then buy them back at a lower price from the open market. Of course, that decision is solely yours. Anybody who owns shares as of the record date is eligible to participate in the buyback. A record date is the cutoff date by which individuals need to own at least one share of the company to be eligible for its buyback. Now, you need to submit a form in which you mention the number of shares you want to tender in the buyback, and the minimum number of shares that can be tendered is usually mentioned in the buyback document. That can be done by using any online broking platform. Do all your shares get accepted in a share buyback? Yes and no. Now, that depends entirely on the company's acceptance ratio. Now, Wipro share buyback recently had an acceptance ratio of 77%, which means that if you tendered a minimum of 500 shares in the buyback, 385 got accepted. Now, acceptance ratio is the proportion of the shares accepted by the company divided by the shares offered by existing shareholders multiplied by 100. For example, if the company wants to buy back 2 crore shares and 2 crore shares or less are tendered by existing shareholders, then the acceptance ratio would be a full 100%. However, if 4 crore shares are tendered compared to a maximum buyback size of 2 crore shares, then the acceptance ratio would be 50%, which means that the company will accept 1 share for every 2 shares held by an external shareholder. So, what happens to those shares that are not accepted in the buyback? They are released back into the individual shareholder's demat account in due course of time. Let's now tell you what an open market buyback means. As the name suggests, an open market buyback is the one in which companies repurchase their shares from existing shareholders in the open market. Now, do companies carry out open market buybacks? Yes, they do. Infosys had 2 share buybacks in 2019 and 2021, both of which were done through the open market route. Paytm's much talked about share buyback was also done through the open market. Now, the open market buyback has a fixed duration like a tender offer, but that duration can run for as long as 6 months or the completion of the maximum buyback size, whichever happens earlier. However, unlike a tender offer buyback, the company announces a maximum ceiling price at which they can repurchase the shares, but it is not necessary that the shares would be purchased at that price. For example, Paytm had announced that they would buy back shares from the open market at a maximum price of 810 rupees. But when the offer was completed, it revealed that it bought back shares in the price range of 702 rupees to 480 rupees apiece. This means that the maximum buyback price was never reached. So far in 2023, companies have chosen tender offer buybacks as their preferred route. Out of the 38 share buybacks announced so far this year, 33 have been via the tender offer route. No story is complete without tax, and buybacks are no different. However, this time the tax implications are more to do on a company level than on an individual level. A buyback tax of 20% was introduced in 2013, payable by an unlisted company on buybacks, with the shareholders' capital gains being exempted. This provision was extended to all listed companies as well in 2019. But when a buyback is done through the tender offer route, the company has to pay the buyback tax. For the shareholder, the tax is deducted at the source and you can claim an exemption from capital gains. But if the buyback is an open market one, the buyers and the sellers remain anonymous, as the selling shareholder does not know who the buyer is. Therefore, the shareholder would still end up paying tax on his capital gains, while the company would pay the same on the shares it repurchased. The quantum of the tax paid, though, would differ. There may of course even be situations where a buyback tax is payable by the company, but no capital gains tax is payable by the shareholder because the shares are being sold at a loss. So this was everything you needed to know about the buyback of equity shares. Want us to do more such videos? Do write to us, like, share and subscribe to CNBC TV 18's social media platforms.